Hi, my name is Ganesh Kapadi, and today me and my group are going to present a presentation on case studies. And my group members are Susabit, Jake, Shakila, and Georgia. These are the contents that we'll be covering in our presentation, which includes transfer pricing, Apple Inc. and multinational tax planning, policy rational tax to the group and allocate profit challenges, complex administrations and legal problems, and many more. Talking about the introduction, multinational companies operate in many countries through subsidiaries. Some occupancies shift profits from high tax countries like Australia to low tax countries using transfer pricing strategies. This reduces the tax revenue and create a unfair competition. Transfer pricing. Transfer pricing refers to the prices charged between the related companies within the same multinational group. According to the OECD arm's length principle, these prices should be market based. However, the companies may manipulate price to reduce taxable profit in high tax countries. Talking about the multinational enterprises MNE's transfer pricing strategy, there are several common strategies. First, companies may manipulate good prices by charging higher international prices. And second, they may place intellectual property such as trademarks or patents in a tax haven and charge royalty fees. Third, they may use intra-group loans where interest payments reduce taxable income, and they may also charge excessive management or service fees. Here is the example of profit shifting. In this example, an Australian subsidiary earns $100 million in a revenue, and then it pays $30 million in royalty fees and $20 million in interest expenses to related companies in low tax countries. Therefore, its taxable profit falls from $100 million to $50 million. This means Australia receives less tax while more profit is recorded in tax havens. Another slide is economic and irregularity impacts. Profit shifting causes major economic impacts. Government lost tax revenues, which can reduce funding for public services such as health, education, and infrastructures. It also creates an unfair burden on domestic firms. In response, the OECD introduced the BEP's initiative and Pillar 2, which includes 15% global minimum corporate tax. Australia has also strengthened transfer pricing audits and anti-avoidance laws and country-by-country reporting. And for the remaining slides, my friend will continue.
Hi, my name is Shakila and I will be presenting a real-world example of multinational corporation that has been criticized for using transfer pricing or a similar structure to minimize tax through foreign subsidiaries. I will be talking about Apple Incorporation, which is a US-based multinational technology company operating globally through numerous subsidiaries. For many years, it attracted international scrutiny over how profits from global sales were allocated among subsidiaries in low tax jurisdictions. Transfer pricing regulates how transactions between related entities are priced across borders, and allocation of intellectual property ownership plays a significant role in determining where the profits are reported. Apple used a structure involving Irish subsidiaries, primarily Apple Sales International and Apple Operations Europe. Subsidiaries outside the United States paid royalties for using Apple's intellectual property. Significant global profits were allocated to Ireland rather than the countries where products were sold. This structure reduced Apple's overall effective corporate tax rate. The mechanism they used was Apple transferred rights to use intellectual property outside the US to Irish subsidiaries, and these subsidiaries received large portions of profits from the global product sales. These profits were shifted to entities with low effective tax rates, and certain entities were structured, Irish entities were structured so that profits were not fully taxed in either Ireland or in the United States for many years. Now, if we talk about the implications and criticisms of this case, in 2016, European Commission ruled that Ireland granted Apple Stated through the favorable tax rulings, and Commission ordered Ireland to recover 13 billion euros in unpaid taxes, and they argued that the profits were artificially allocated to subsidiaries that were existing for mainly for the tax purposes rather than the economic activity. Apple and Ireland appealed the decision, and this demonstrated how complex transfer pricing disputes can become at international level. The criticism focused on reducing global effective tax rates, exploiting differences between the national tax systems, and using of intangibles to justify profit sharing. There are many implications for this case, and it caused increased global regulations for the transfer pricing and focus on the economic substance over legal form, and it influenced OECD to reform BEPS.
Hello everyone, I'll be talking about the policy rationale for consolidation group taxation. These slides introduce the main policy reason for adopting a consolidation group taxation model. Government are concerned that multinational enterprises often operate as one of the global business, but they are taxed as a separate entity in each country. This creates an opportunity for profit shifting, whereas company can move profit from higher tax countries to lower tax jurisdiction, transfer pricing, royalties, and so on. A consolidation group taxation model's main aim is to solve problem by looking at multinational group total global profit and then allocating taxable profit to each country based on real economic activities such as sales, assets, and employees. This helps ensures that tax is paid where value is actually created. The slides explain why the traditional separate entity taxation model created tax risks for government. Under this model, each subsidiary of multinational company is treated as if operate independently. However, in reality, many multinational enterprises are highly integrated and control price and payment between related company. Let me give you an example. A subsidiary in a high tax country may pay large royalties, uh, interest, management fee, or service charge related to a country company in a low tax country. This payment reduces taxable profit in a high tax country while increases profit in low tax country. This creates a fairness issue because tax revenue may not reflect where customers, employee, assets, and real business activity are located. The slides explain why the traditional separate entity taxation model created tax risks for government. Under this model, each subsidiary of multinational company is treated as if operate independently. However, in reality, many multinational enterprises are highly integrated and control price and payment between related company. Let me give you an example. A subsidiary in a high tax country may pay large royalties, uh, interest, management fee, or service charge related to a country company in a low tax country. This payment reduces taxable profit in a high tax country while increases profit in low tax country. This creates a fairness issue because tax revenue may not reflect where customers, employee, assets, and real business activity are located.
Challenges or obstacles when implementing a consolidated group taxation system are international coordination challenges, complex administration, legal problems, and political resistance. International coordination challenges. One of the biggest obstacles is achieving agreement among countries on how the system would operate. Countries may still disagree about how much profit belongs in each country. This could lead to double taxation or conflict between the tax authorities. Some low tax countries may oppose the system because they benefit from the current tax rules. Under consolidated taxation, global profits must be allocated among countries using a formula based on economic activity. For example, market countries where customers are located may favor sales-based allocation, while manufacturing countries may prefer formulas based on asset and labor. Complex administration. Although consolidated taxation may reduce some transfer pricing dispute, It introduces new administrative difficulties. Complex administration is a challenge because a consolidated tax system would require new rules and systems to calculate and collect taxes. Government would need to agree on shared accounting methods, collect large amounts of financial data from multinational companies, and decide how to divide profits between countries. This would increase paperwork, compliance costs, and the workload for tax authorities, making the system harder to manage. Legal problems. A consolidated taxation model will require substantial legal reform. Current international tax laws and tax treaties treat each other company within a multinational group as a separate business for tax purposes. This means each subsidiary is taxed individually in the country where it operates. If a consolidated group tax system is introduced, countries would need to change many existing laws and agreements because the whole multinational group will be taxed together instead of separately. This makes reform legally difficult and time consuming. Political resistance. Power pressuring from multinational corporations could therefore slow or weaken reforms. Political challenges may arise because government, business, and the public may have different interests about the new tax system. Some countries may not support the reform because they fear losing tax revenue or foreign investment. Large multinational companies may also oppose the system because it could increase their taxes and reduce opportunities for tax planning. These disagreements can make it difficult for governments to introduce and enforce a consolidated group taxation system.
Good evening, ma'am. I will now present the recommendations to reduce profit sharing. So, I'll first walk you through the policy oriented key recommendations that align with current global tax reform trends. These key recommendations are: first, implement OECD Pillar 2 global minimum tax, which is 15%. Second, strengthen transfer pricing audits, expand country-by-country reporting, increase international tax cooperation, and tighten rules on IP royalties and intergroup loans. Our first recommendation is the implementation of the OECD Pillar 2 Global Minimum Tax of 15%. So why this matter? Currently, multinationals can shift profits to subsidiaries and tax havens with zero or very low tax rates. Under Pillar 2, if a company pays less than 15% in any jurisdiction, the home country can impose a top-up tax. So this directly reduces the financial incentive to shift profits artificially. So, as the OECD notes, this reform supports fairness between multinational corporations and domestic businesses that cannot use such strategies. And second one is tax authorities must strengthen transfer pricing enforcement. So this means only a conducting stricter audits to related party transactions, especially royalty payments, management fees, intergroup loans. And these are the most common channels for profit shifting, as shown in our earlier Apple case study. So authorities should enforce the arm's length principle rigorously and use country by country reporting data to flag mismatches between where profits are reported and where real economic activity like sales, employees, and assets actually occurs. Third, increase international cooperation. No single country can solve this alone. We need greater international cooperation. Our recommendation is to expand automatic information sharing between tax authorities, similar to the OECD's Common Reporting Standard. When tax authorities in Australia, US, or Ireland share country by country reports in real time, it becomes much harder for MNEs to hide profits in opaque structures. Digital reporting systems can make this both efficient and transparent. And finally, tax authorities should shift their focus from legal form to economic substance. What does that mean? Instead of accepting a tax structure simply because it is legal, authorities should ask, where are the actual employees, customers, assets, and operations? If a subsidiary in tax haven reports billions in profit but has no office and only three staff members, that is not genuine economic activity. Anti-avoidance laws like Australia's multinational avoidance law should be expanded to penalize artificial agreements.